Hello, everyone, and welcome to our State of the Markets presentation. We're delighted to have you all here with us today and look forward to sharing some important information with you all. So over the next 45 to 60 minutes, sit back, grab your favorite beverage, and we'll dive into some stuff. I think you'll find today's presentation pretty interesting. Before we begin, I just do want to cover some disclosures. And so Triumph Capital Management is an independent firm with advisory services offered through Triumph Capital Management. The information that you will all be getting today is provided by Triumph Capital Management. It is for informational purposes only. And the views and opinions expressed may change at any time based upon market or other conditions that may not, be present today. The material is not really intended to be relied upon. It's really for educational purposes only. And obviously, we encourage you to seek professional guidance with any of the information that you receive here today. So I'll leave that up on the screen for another few seconds just to make our attorneys happy. Next, we'll dive into some formalities. So the first thing is if you'd like the slides for today's presentation, they're already made available to you. You do have handouts that you can download. So if you'd like to download today's presentation, you can go ahead and click on your handouts and download that PDF to your computer. Also, tomorrow, you will all receive a recording of this presentation in your inbox. So you will have that as well. You can always also visit the Triumph Capital Management website. If you click on the Events tab on the website, this will post as a past presentation tomorrow. If you do go to the website and you click on the Events tab, you can also see some other presentations that we've done over the last 30 days, including the Biden tax proposal, as well as 2021 tax strategies. We will have a few more upcoming presentations, most of which will occur in about a month from now. You will all get invited to that, and you will also see them posted on the website. They're not up there yet, but they will be by the end of next week. Anyhow, for most of you on the presentation today, we know each other, but a little bit about myself, your speaker today, Derek Eichenwald. I am the CEO and Senior Investment Executive here at Triumph Capital Management. But enough about me. Let's jump into today's agenda. So today we'll talk a little bit about how stocks performed through 2020. That's just to kind of wet our beaks and get us kind of talking about where we're going for 2021. We'll talk about what drove market performance through 2020. We'll talk about where are we now. We'll talk about forecasts, as I mentioned previously, into 2021. But let's kind of begin with a review of 2020. So how did stocks perform through 2020? As a lot of you know, at the beginning of almost every single year, there's a lot of predictions that are made. So on your screen right now, you can see, in December of 2019, here are predictions from some larger analyst firms of where they thought the S&P 500 would end up. If you average out the group there, it came out to the S&P ending the year at 3,272. As you can see on your screen, the S&P actually ended the year at 3,756. The S&P 500 was up 16.26% during 2020. So it actually was one hell of a year as far as rate of return was 16%. Of course, 2020 was a crazy year. And so, what kind of drove this market performance and what happened? So as you all know, the coronavirus pandemic was a dominant influence on the stock market and the stock market's performance through 2020. In addition to some real pain that was caused throughout the year. It caused many companies here in the United States as well as abroad to not be able to forecast what their profits would be, not be able to give wonderful guidance on what was going on. It also impacted the Federal Reserve and the Federal Reserve's monetary policy, as well as government spending. And it was really kind of a strange year for everything that happened. And we're going to cover some of these things in more detail. But let's jump into in the next few images, we'll talk about the market through 2020. So the first thing that you're seeing here is this chart is showing you the S&P 500 from April 19th, 2019 until April 7th, so the close of business yesterday. I just put this graph on here yesterday. So the close of business yesterday, April 7th, 2021. As some of you may remember, 2019 was just a really fantastic year for the S&P 500. In fact, the S&P 500 ended up for the year performing 28%. It was really about 28.88, so we'll call it 29% through 2019. We continued that run into 2020, and we hit a wall really on February 20th. So on your screen, you can see here, this is back to April of 19, and you can kind of maybe see this blue line. That was the end of 19, but you can see here the S&P continued to go up. And right about on February 20th, we hit this wall. And what you see here is you see the S&P 500 going all the way down from where my laser pointer is all the way to a low of S&P 500, 2,192. In the first 2 months of the year of 2020, the S&P added 3.5%, and it was really kind of setting up for a spectacular year. As I mentioned, on February 20th, we hit this wall, and from February 20th, interestingly enough, until March 20th, so exactly 1 month, the S&P 500 experienced a 35% loss, and that's this big drop that you see right here. Obviously, towards the end of March and into April, you see this nice big rebound. And as many of you are aware, we've been on a nice big rebound since. We'll talk more about that. But let's zoom into this a little bit. And when I zoom into it, what you'll now notice is that we've color-coded 4 key market drivers. We've identified dates where each of these factors moved the market significantly. The S&P 500, as many of you know, is an unmanaged index of stocks that is generally considered to be representing of the U.S. stock market. I do need to mention to keep in mind that past performance does not guarantee any future results, and individuals cannot invest directly into an index. When I say that, sometimes people challenge me, but I say you can't. You cannot invest into an index. Yes, you can get very close by buying different ETFs and these types of things, but no, you cannot invest directly into an index. So let's kind of look at these things. COVID-19. Obviously, it isn't often that a global pandemic drives stock market action. We've seen a lot of them cause very few. We've seen a lot of pandemics cause little gyrations in the market, but nothing like we saw in 2020. In 2020, obviously, COVID-19 really did, affect the markets greatly. As you see in February and March, we identified 2 key dates that were really the opening act on the coronavirus pandemic. And it affected so many Americans. Markets were initially, as you know, slow to react. We started to see news overseas and that type of thing. But again, markets here in the States really didn't react until late February. And markets had that huge sell-off, 35% on the S&P 500. And then, what we then started to see is in record time, we started to see, in December, the FDA approved the first vaccine, or was talking about first vaccines, and we started to kind of see this market come back. Then we had monetary easing and fiscal policy. In response to markets that were seizing up, the Fed stepped in. with an unprecedented series of actions, including cutting interest rates to basically zero. The federal government followed that with other unprecedented actions and bipartisan agreements, spending a massive $2 trillion via the CARES Act. And that was to provide individuals, American businesses, and companies with immediate relief. These actions really ended up setting the groundwork for the eventual recovery, as you can see here on the screen, that, occurred on the graph. The economy, with the spreading of the virus and the widening economic lockdowns, the economy shrank, with the worst of it coming in the second quarter of 2020. The economy rebounded in large part due to fiscal and monetary steps that we just discussed, as well as due to the summer months there being this thought that the coronavirus would slow its spread during the summer months. Corporate earnings. Well, most investors gave a pass to companies about reaching pre-pandemic earning targets. Investors were often finding themselves surprised by the strength of earnings, given the economic landscape. This was especially evident following the close of the second quarter. Earnings have since continued to rebound, but for many industry sectors, there really does remain some ground to be made up. Okay. As you may remember, the Federal Reserve was raising rates through 2019. Through 2019, the Fed was raising rates because the economy was really, really strengthening. Okay. However, and as I previously mentioned, in light of the pandemic, the Fed implemented 3 rate cuts, as you can kind of see here in 2020, and they cut rates all the way down to where they are today. That said, the Fed's policy response to this economic challenging wasn't limited to just cutting federal funds rate. As we'll see in some of the next images, the Fed pulled several levers to address immediate dangers facing the economy and the capital markets. So, what else did the Fed do? These are just a few of the steps that the Fed took to combat the disruptions in the markets caused by COVID-19. But many of these items are somewhat considered, what does this really mean? However, it's important to see the range and scope that the Fed went to in just a very short months. In fact, a very short amount of days to really make sure that the economy stayed on solid footing. A lot of times when we look at this, arguably, did the Fed learn a lot from the financial crisis in 2008? And we believe they did, right? In 2008, the Fed was somewhat criticized for not taking action quick enough. In this case, they acted in record speed. Beginning with the surprise Sunday evening conference, many of you may remember that. Jerome Powell was on TV on March 15th, which was Sunday evening. And he announced a drastic reduction to the federal funds rate. The rate went from 0.25 to 0%. And they committed $700 billion in asset purchases to maintain liquidity in our credit markets. Now, March 16th, the markets opened up, and the markets really didn't like this. Markets sold off. We had a north of 1,000-point sell-off inside of various markets. I think the Dow was down over 1,000 points, and markets really greeted this news by the Fed to take hey, even though they're here to help, they see a lot of danger. And so, as I mentioned, markets sold off. But as the timeline illustrates, you can see the Fed continued to implement new measures to steady the financial markets. And while the Fed did implement more programs than we have outlined here, if we take a look at some of the key policy initiatives put in place during the worst of the market slide, they included the following: the creation of the commercial paper funding facility, which was really designed to buy short-term unsecured debt, which was critical to business funding. The creation of the money market mutual fund liquidity facility, and that was to promote the purchase of assets from money market funds, ensuring that money markets didn't break the buck like they did in 2008. Funding was provided to support credit to large companies and revive the 2008 term asset-backed security loan facility, and propped up corporate bonds. It's quite amazing when you look at another step that they took, which was the PPP, or the Paycheck Protection Program. PPP, if you paid attention to it on the news, it went out to a lot of small businesses, right? And then there was also some news about large businesses taking PPP. But what a lot of people don't realize is some of the key points that I just mentioned, as far as the Fed stepping in and for the first real time in history going into the capital markets and buying bonds. And so what the heck does that mean? Well, imagine you were a big company today and you went, hey, I need to go borrow money. What does a big company do? They don't go to the bank. They go to the bond market and they issue bonds. The thing is who's going to buy their bonds? Well, you don't know exactly what bonds the Fed's buying, right? Because they don't tell you, but they stepped into the marketplace. What that did was A, allowed big companies to borrow, and B, for companies that had debt or bonds out there that they were paying 6-7% on. With the Fed cutting rates and the Fed then being a secret buyer of the bonds that were to be issued by companies, a lot of companies financed their balance sheet. They called in their bonds that were paying 6-7%, and at the same time they reissued bonds paying maybe 3 or 4%. Very similar to, over the last 6 months, so many people have been refinancing. Why? Because people's loans on their homes were at 3.25 or 3.75 or even higher than that. And, during this time, people are refinancing down to 2.75 or even 3%. Point being is the whole bond buying program by the Fed did that for big businesses, helped them with their balance sheet. Well, the PPP program, gave liquidity to small business owners, medium-sized business owners, and it really helped facilitate bank participation inside of these loans. Sweeping changes were introduced to the Main Street Lending Program to make it possible for a broader range of small and medium-sized businesses to apply to receive such loans. And what does it all mean? Remember, in the previous image, we showed the stock market's performance in the first half of the year. On May 18th, stocks notched another solid gain after the Federal Reserve restated its commitment to do whatever is necessary to support the economy. And this was all going on as crazy things were happening in the market, right, from February up until May, and that kind of started to settle in. With the economic shutdown and, increasing COVID-19 cases, corporate earnings dropped. And future earnings became, as I mentioned earlier, very challenging to predict. We didn't know when the economy was going to go back, open back up. Companies actually started to not provide forward guidance, and in absence of such guidance, in the face of an economic contraction, Wall Street analysts cut 2020 earning estimates multiple times. It turns out that the economy rebounded faster than many expected. In fact, many companies surprised investors with better than expected numbers in both the third and the fourth quarter of 2020. And overall earnings today, we're kind of seeing where they're coming in. We're getting into earnings season, but they're looking good. As you can see on my chart here, you can see where the expectations are going, and all expectations that earnings will come in better than expected. And I'll make some more comments of this. I'll tie this all up and put it all together at the end. We'll get into some P ratios. So, it's a very challenging time, especially without guidance. So, we look at a gazillion different economic indicators to try to help our clients and help us manage clients' money. But, when we really looked at this, one big economic indicator is GDP growth. Well, in the first quarter, we were looking pretty good, right? Things were looking pretty good. Again, we hit that wall in the middle of February. And Q1 GDP 2020 was a negative 5%. Q2, that's when the shutdowns really started to affect things, right? Look at that. Q2, negative 31.4%. Pretty crazy. Good news is we did follow that up with a positive GDP of 33.4% in the third quarter. And for the fourth quarter of 2020, we had positive GDP of 4.1. By the way, obviously we're not through Q1 of 2021, but we will give you a forecast on what we see going on there. Next on my screen, you see the labor market. And so you can see here when it says labor market, what that's really doing is that's showing you the unemployment rate. Unemployment, when you think about it, kind of a healthy unemployment number is someplace around 5%. You may say, how's that healthy, Derek? Why would that ever be healthy to have an unemployment rate of 5%? The reason is because if you have unemployment below 5%, what happens is that there's employers out there looking to hire, and they can't find anybody to fill the job. So a healthy unemployment rate about 5%. You can see in Q1 we were right about there, 4.4. In fact, a little too good at 4.4. But look at that. Q2, you saw unemployment shoot up to 11%. Obviously, as some markets in Q3 and Q4 started to open back up, we started to see that unemployment rate go down. Now, at the same time, inflation. So, over the last month, you've seen the markets kind of get a little volatile because you've heard, there's inflation setting in, and I'll wrap that up for you as well, how that inflation affects the Fed and everything else. But the reality is when we look at inflation through 2020, you really didn't have any inflation. We're going to talk a little bit more about inflation. If you drop below consumer confidence, I don't want to comment on that today, but you look at manufacturing, and we'll talk a little bit more about manufacturing or the PMI here in a few slides. Look at manufacturing completely drop off a cliff, right, as we got numbers for Q1, Q2, and Q3. Of course, in Q4, manufacturing's picked back up. But let's keep working here. Let's see where we are now, and let's kind of talk about some stuff. We looked at factors affecting the market performance in 2020. A lot of it, as you all know, came from the coronavirus pandemic, and then a lot of it came from the Fed injecting just a ton of stimulus and being a buyer of refinancing balance sheets and everything else. And companies, even though it looked like, hey, no one was going to be making any money, again, companies had earnings that they weren't wonderful, but they weren't as bad as expected, and you saw that market kind of revert to its mean. Many of you on the call are familiar with this. These are our speed dials or economic indicators. So here what you're looking at is you're looking at a group of 20 indicators. The indicators help forecast pressures on the economy and the financial markets over the next 3 to 6 months. Green, obviously, is positive. We might call that a tailwind, help pushing the economy growth along. Yellow is caution, and red is a headwind, which acts as a potential brake on economic growth. As you can see, this chart shows you where we were in December of 2010. We see a lot of green on the board. The economy was beginning, coming out of the great recovery of 2008. So I'm bringing you all the way back to 2010 to show you what the speedometers looked like back then. The only indicators flashing caution were credit availability and houses and mortgages, right? This is after the 2008 credit crisis. And you can imagine that, right? As far as the two areas being in red, credit availability, banks were still very tight, and houses and mortgages, because banks were very tight, people, it was more difficult to get loans. As we entered 2020, this is what our speedometers look like. So this is 10 years later. The economy kind of presented a mixed picture. As you can see, there were several green indicators signaling potential economic strength, but also near equal number of cautionary indicators, indicating that leading economic indicators in the yield curve. Plus, there were two measures in the danger zone, being geopolitical risk and the political environment. And so, if we jump a few months later, to November 2020, when we approached year end, we did this presentation. And as we approached year end, the economic indicators pointed to a mixed picture of the economy still. As you can see, only 7 of the 20 indicators were in green, including monetary policy, which remains very accommodated. Housing, which has been a very good source of strength. In the index of leading economic indicators, which is modestly, positive signs. 4 indicators were signaling red, most notably in current equity valuations. We're going to talk a little bit about valuation levels here in a moment. And finally, many indicators, nearly half of them, were indicating caution in yellow. Weakness in consumer sentiment in the labor market may have been the most troubling, since our economy is normally driven by a healthy consumer, which I'm also going to show you in a second. So let me go to today's indicators. Today, so this is March 31st, 2001, and as of March 31st, 2001, the gauge is showing you 14 of the 20 economic indicators are in green. We have nothing in red. You do see a few in yellow. The few that are in yellow we will hit on, but we'll hit on a little bit more in depth through today's presentation. But obviously, disposable personal income, we still have unemployment that's pretty high. I'm going to show you that in a minute. Energy costs are obviously rising. It's not a huge concern for us now, but if we went back a few months ago, you would have saw energy costs in green. Obviously, you've noticed it at the pump. Equity valuations we're going to talk about. You see that down the bottom in yellow. I think political environment and geopolitical risks have always kind of been in a yellow or a green. I think over the last 15 years of kind of showing you all these gauges, I don't really think, I can never remember those two gauges being in green. So they seem to always be in red or in yellow. When we take all 20 of these indicators and we mesh them together, and we put them on a graph, which is now shown on your screen, that orange line represents all of those meshed together. Those gray lines that you see are areas of recession. Now, the good news is you never see that orange line going up, okay, in a recession occurring, right? This is us coming out of the recession. So that's good news. When we put that onto a graph, it looks beautiful like that. We'll talk more about that stuff. Okay. So we just saw from the leading economic indicators and the economic speedometers that the economy outlook is quite good. Recovering from the coronavirus included recession. When we're recovering from this coronavirus, this recovery is fragile, just like coming out of any type of recession. It is fragile, especially in a resurgence of new strains of the coronavirus, so on and so forth. Obviously, every day we're getting great news about these wonderful vaccines that we have, and 100 million Americans being vaccinated by in 10 days from now, and this is all great news. We also see several headwinds, right, for the market, and it could kind of derail us a little bit. Although the vaccine is going good now, who knows, right? Who knows? It's going fantastic now, but who knows? New strands, these types of things, obviously that could be an issue. We have seen some scares come into the market with inflation, and again, I'm going to talk more about inflation here in a second and how the Fed combats it and why that caused some volatility in the market. At the same time, even though, let's say nothing happened, let's say this coronavirus things get behind us, vaccines all work, no second strands, so on and so forth. Think about Main Street. Think about Main Street businesses in your communities. You see these stores, they've been closed for a year, small restaurants, small business owners, that type of stuff. So balance sheets of Main Street businesses is what I'll refer to them. How quickly can they recover? Corporate balance sheets, although the Fed did step in, as I explained earlier, but corporate balance sheets in such industries like travel and hospitality have been damaged. They've been damaged in a way that they've never been damaged before. So, will these companies have the balance sheet or the ability to rehire workers and invest in growth? And generate profits, obviously, right? I know everybody sees on the news, hey, there's lines in Las Vegas. A gentleman who I work with here at the office, he was picking up his father from DIA Monday evening. He called me on the phone and he said, I haven't seen the airport. I haven't seen the airport like this in forever. He said, there was lines of people and, a lot of cars swarming around and that type of thing. So, there's a lot of hoopla around that stuff, and hopefully it's here to last, right? But, will these companies that have been damaged have the balance sheets to rehire workers? Well, interest rates are expected to remain around historical lows, okay? A lot of professionals anticipate that rates will start to rise. And so we'll get into that as we go through the slides today, right? And obviously, geopolitical events are always wild, and it's always a wild, crazy card. What can happen? You see some renewed saber rattling from places like North Korea and Russia and China, and China threatening Taiwan, and Russia invaded a neighbor country, and all these types of scenarios can certainly affect the markets. In fact, this morning, I was reading in the Wall Street Journal about a whole political, a whole election in Greenland. Greenland has about 56,000 people that live on it, but a whole election in Greenland swayed the other way. Greenland hosts a whole bunch of raw earth materials, and one party in Greenland was able to steal it from the other party in Greenland, and it all had to do with them allowing a Chinese company to ore for raw materials in Greenland. So these things can't affect the markets. Of course, the Greenland thing it didn't affect the markets. The Greenland thing's on a small scale, right? 56,000 people. But as you all know, geopolitical events can affect things. We keep working here. We believe that there are a number of tailwinds that could continue to support economic growth through 2021. Again, the rollout of the vaccine, continued monetary accommodations. I was on the phone with a realtor client of mine 2 days ago, and he said, hey, did you apply for the second round of PPP? I said, no. And he said, I did, and it was great. So, second round of PPP, assuming that markets start to open back up, corporate profits really should be on the forefront. We'll see as we get into earnings season for Q1 and then into Q2. Healthier consumer. So, people getting back to work. I'm going to show you the unemployment rate. It has been coming down. People getting, extended unemployment benefits and now getting back to work. So, there's the consumer coming healthier. Prospects of reduced trade tensions with different ally countries in China as well. And so, as those trade tensions maybe go away via the Biden administration, the markets will like that, especially in the short term. And moderate inflation. What scared the markets over the last 30 days was obviously this peak up inflation. Again, we're going to talk a little bit more about that here in a few. But we do believe that inflation will be very tame through 2021. All right, so let's keep working here. So what you have here is you have equity values, March 31st, 2021. So I want to examine this chart with everybody because if you remember, one of the speedometers that we had was equity valuations, okay? And what you're looking at here is you're looking at PE ratios. Now, what in the world is a PE ratio? Let me just explain it like this. Many of you have heard me explain it like this in the past. Let's say you own an ice cream store, and your ice cream store brings in $1 million a year. But you have expenses with your ice cream store. You have the cost of rent, the cost of employees. You make your own ice cream, so you also have the cost of, the cream, the sugar, and everything else. At the end of the day, after you pay all your expenses, the business makes $100,000. Well, if you went to sell that privately held company, that privately held ice cream business that you own, the business would typically sell for 3 to 5 times earnings. In other words, somebody would write you a check for 300 to 500 grand for the right to ring that register for the next 30 years. That's the price of the business divided by earnings, or PE ratio. By the way, if that company was publicly traded, that ice cream store is now publicly traded. Publicly traded companies carry an average over the last 25 years of a PE ratio of 16.6. You can see that on my screen here. And all that means is, again, the ice cream store made $1 million, had expenses of $900,000, leaving the ice cream store with $100,000 of earnings. And if it was publicly traded, it would now value at about $1.7 million. When I say that to people, they say, that's crazy, Derek. If I sell it privately, it's worth 300, and if I sell it if I was publicly traded, it's worth 1.7. It's about a 12% difference. Well, that 12% difference is what we refer to as the liquidity premium. And so you're like, what does that even mean? Well, if you think about it like this, let's say tomorrow morning on the front cover of the newspaper, it says, ice cream causes cancer. And you and I own this ice cream store. Not publicly traded. We own it privately. Well, we can't just hit a button on our computer and no longer be in the ice cream business, right? We have an ice cream store, and now on the paper, ice cream causes cancer, and we can't get out of it. And so if we were publicly traded and that were to come out in the paper, we can immediately be out of the ice cream business. And because of that liquidity, publicly traded companies get about a 12 times higher valuation. Now, what you can see on my screen right now is currently, okay, and this is as of March 31st, but as of March 31st, PE ratios on the S&P 500 were at 21.88, meaning that companies were overvalued, right? The average is around 16. We love to buy companies that are below average, and we love to sell companies once they get above average. So this is one of our concerns, that equity valuations are a little frothy. By the way, I think my slide was in the wrong place. I think I moved it on mistake, so I think that slide's supposed to be later in the presentation. So I'll probably come back to it because we're getting into 2021 forecasts, and I believe I think that was one of my last slides, so I may come back to it. But anyways, inflation. So inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little inflation can be a sign of economic weakness. Inflation, as you all know, remained amazingly low through 2020. As the prices of consumer goods and services rose only 1.2% year over year. By the way, food and energy are broken out on this graph in front of you, since they tend to move more volatile. They're more volatile on a month to month. And so as you can see, the increase in food prices was substantially higher than the overall basket of goods, so the overall basket of pricing. And food prices raised 3.7 year over year. However, energy, as you all know, hit zero. Energy hit zero during the coronavirus pandemic. There's a gentleman in my office here. It's not in my office. He's the building facilities manager. His name's Mel. And Mel came running up to my office the day it hit zero, and he said, he's from Croatia. And he said to me, Derek, if I go to the gas station, can I fill up for free? And I said to him, well, Mel, I don't think so. And you should have saw the look on his face. He ran out of my office, and I'm sure he got in his truck and drove over to the gas station to see if he could fill up for free. But, energy costs went way down. And inflation, I guess, all is said is very tame. Now, just so that everybody knows, the Federal Reserve actually has a target. They would like inflation to be about 2%. That's published by the Federal Reserve. So they'd like to see inflation at around 2%. And so we'll talk a little bit more about that. What you see here is a graph of what the inflation rate has been every single year from 1990. So if you notice on the left-hand side of your graph, you see inflation during 1990 was 5.4. You saw inflation through the 90s, even into the 2000s, right? You can see that all there, but hovering around a 3%. After or during the economic crisis, the credit crisis, we actually had deflation. And really, since over the last 12 years, our average inflation rate in the United States has been about 1.2%. Now, in 2021 through 2021, we're expecting inflation to be about 2.4%. Okay. 2.4%. Now, why is that? Well, we don't expect food prices to come down, but we are seeing energy prices going up, okay? And even though inflation is still extremely low, what happens is when you have inflation, the Fed wants to raise interest rates to cool down the inflation. Problem with raising interest rates is, especially right now, is things are just too fragile, right? Things are just too fragile. And so, a little bit of a tornado there. If we keep working here on the inflation front, what I'll show you, 50-year average of inflation is shown right here. The 50-year average inflation is more like 4%, or as you can see, 3.8. On the inflation side, we can see January 2021, February of 2021 still holding very steady at about that 1 point, we'll call it a 1.6. So again, much lower than the average over a 50-year period. And when I say much lower, you might go, well, Derek, 3.8 to 1.7. That's pretty close. It's actually a 48% difference, a 48% difference. So it's a big difference where inflation is. One economic indicator that we look at here in the office is we look at what's going on with inflation globally, and then we'll look at each country. So this graph that you're seeing here is taking all of your developed and emerging market countries, and it's showing it to you on this global graph here. You can see as you kind of come down here, you see DM, that stands for developed markets. EM stands for emerging markets. And then below it, you see the US, Canada, Japan. But let's just focus on the US for a second. As I mentioned, right, back before, if I were to go a few slides back, in 2008, right, that was before the credit crisis, we had some high inflation. You see in 2009, remember we had that negative 0.4, but see that strong blue bar there? Well, blue is good, red is bad. And so as you can see here, right, globally our inflation is very low, 1.2%. You can see right now, and this right here is this graph right here is actually as of March 31st, 2021. And you can see everything in blue. We do not have a big concern for inflation. We might talk a little bit more about that here in a second. GDP numbers. So, GDP, as far as what we're expected or where we're expected to go through 2021, we're expected to have some wonderful looking GDP numbers and also lowering unemployment. This is a wonderful recipe for an expanding economy and therefore more than likely good corporate profits. So not only do you see GDP or gross domestic product growing each quarter of 2021, you also see the unemployment rate coming down. I'm going to show you some better numbers on it. Here, what you're looking at this is again as of March 31st. As I mentioned earlier, you can see 2020, what GDP was. Okay. You can see the forecast for 2021. That's why it has an F after it. And then you can see 2022. So again, nice looking GDP numbers, which is always fantastic. We also threw in this graph. This graph will show you GDP every single year from 1990 until 2020. obviously 2020 was kind of a crazy year for GDP. Um, but I also talked about people getting back to work, and there's a reason why I talked about it. When we look at GDP, what drives GDP? Well, as this will show you, nearly 70% of GDP is driven by consumption. In other words, you and I going out there and buying stuff. Okay. Um, 7 to or 18% comes from government spending, and about 14% comes from investments, not including housing. But again, 70% of GDP growth comes from consumer consumption. I'll never forget after the 9/11 attacks in New York City. A day or two later, President Bush at the time took the stage, and I remember him. He kind of said something, and then he went, well, "Go out and buy something." And I think what he meant by that was somebody probably just told him, "Hey, people, we don't want people to be locked away in their houses. We want people out there consuming." And what he was trying to convey was, look, in order to keep our economy continuously growing, people got to be out there spending. So again, with vaccines coming, with people getting back to work, with what the government programs did to keep people afloat, okay, during the recession or during the pandemic. Hopefully we continue this ball rolling, and with people getting back to work and hopefully what they have in their bank accounts today, we'll see consumption, and consumption leads to corporate profits, okay? When we look at unemployment, wages, and inflation, we want to tie all that stuff together. And so I'm actually going to go to this chart here. So what you're looking at here is this is a chart of unemployment and also wage growth. And so what you're looking at here is the data is as of March 31st. Again, the 50-year average of the unemployment rate, as you can see here, 6.3%, okay? And we've seen wage growth on average of 4%. This is over a 50-year period of time. But here's what I'm saying. If we go back to April, so a year ago, the unemployment rate here in the U.S. hit 14.8. When we look at what the unemployment rate was, okay, on March 31st of 2001, unemployment's come down to 6.2. In fact, below the 50-year average. Now, wage growth. I'm saying to you, wage growth over a 50-year average has been 4% a year, okay? However, year over year, so from February 2020 to February 2021, we've had wage growth of 5.1. Now you go, okay, Derek, well, that's good. It's above the 50-year average. No, here's what I want you to hear. We had inflation year over year of 1.2%. We had wage growth of 5.1. Therefore, Americans got a true raise of about 4%, right? If you have inflation at 5%, you have wage growth at 5%, nobody got a raise, right? Inflation just ate it up. Well, these things paint a good picture for the economy and then therefore hopefully the market. What you're looking at here, as I mentioned it earlier, what you're looking at here is you're looking at a graph very similar to the one I showed you earlier about inflation, so kind of the same data points. But what this is the PMI, or the Purchasing Managers Index, something that we look at every single month and we get little updates on every week, okay? And what this is basically looking at 19 different industries, and it covers both upstream and downstream activity. The purpose of the PMI numbers is to provide information about the current business conditions that are going on. Now, PMI above 50 indicates an expanding economy, where PMI below 50 is worrisome. Well, what you can see here is globally we have a PMI of 53. Here in the United States of America, look at that PMI. It's on fire, 59.1. Yeah, there's some trouble split places like Spain, so on and so forth. But in large part, if you look at the big economies out there, okay, the big economies out there, we're looking pretty darn good. Globally, 53, developed markets at a 53, and emerging markets merged together at a 52, and the U.S. being the strongest out of them all. So this is all good news. So at the beginning of 2021, the same firms that I showed you at the beginning of this presentation also put a target in for the S&P 500. Once again, you can see that the average of the group was S&P 500 4,117. Um, the S&P 500, okay, closed December 31st of 2020. The close was at 3,756. Yesterday, the S&P 500 closed at S&P 4,080. So pretty close to the group average. Okay, so pretty close to the group average. Now, obviously, we've all heard about this great tactical movement in the markets in 2000. And by the way, Apple was gobbled up by the S&P. So the S&P got a lot of movement through 2020 with some of the tech companies that they gobbled up. But during 2020, technology, right, was the leading area. As you all know, tech stocks did extremely well. Interestingly enough, as of March 31st, these are the areas of the S&P and how they performed. So you see energy, quarter to date, energy was up 30.9%. By the way, energy only represents 2.8% of the total S&P. You can see materials, which represents 2.7 of the S&P, was up 9%. Financials, which was a lagger, right, in 2020, up 16%. Financials represent a good chunk of the S&P 500, 11.3%. Technology, okay, a lot of people don't realize this, but the technology sliver of the S&P has been growing and growing and growing and now represents 26.6%. But technology has been a underperformer thus far in 2021 as money is kind of rotated out of those high-flying, high-valuation stocks into stuff like energy that hit zero, like financials that were very depressed through 2020, and these have been the winners, for the first quarter of 2021. The S&P 500 index, as of the close of business on March 31st, was up 6.2% for the year. Many of you have seen this graph, at least many of you that I know, and this is just kind of pointing out to you every area of the market from 2006 until March 31st each year. But interestingly enough, if you can see on the screen there, I'm circling value companies, which were down negative 0.2% during 2020. And obviously YTD, those value companies being the winner at 18.5%. One graph that I always like to show everybody is I like to show them this graph. And what you're looking at here is you're looking at the S&P 500 from 1980 until the end of 2000. I'm going to show you on the next graph, I'm going to show you where we are today. But the little red dots that you see are saying, hey, in any year, at one point, this is how much the market was down. So, for instance, in 2020, at one point, as I mentioned earlier, the S&P 500 was down 35%, and that's why you see that dot there. However, the market in 2020 ended up 16%. So the blue bars are what the market ended up for the year, okay, whether positive or negative. Well, the red dots are showing you during that year what the intra-year low was, okay? Year to date, when I say year to date, I mean March 31st, same exact chart, except for, again, you see YTD, the S&P 500 up 6. At one point during the first 3 months of the year, the S&P 500 was down 4%. Moving right along. Major market pullbacks. So if we go back to 1994 and we look at major market pullbacks, and you think about some of these things, you remember the Asian financial crisis, right? That happened kind of right before the collapse of the tech bubble, right? And we saw the 20% drawback in 98. 2002, we saw 50% drawback in the S&P 500. We then got to the global financial crisis, started on March 9th of '09, a 60% drawback. June of 2010, we had that whole European sovereign debt crisis and 20% drawback, so on and so forth. But, this coronavirus drawback was very short-lived, again, about a 35% from peak to trough, okay? And here we are today coming out of it. Many of you know this by looking at your investment statements. Many of you have seen this. This is basically the S&P 500 from 1900 until current date. So this is as of March 31st. No, the S&P 500 did not exist back here. However, they've put together kind of an S&P 500 to see what it would do. As many of you know, we had this great cycle after World War II when everybody came back, just a ton of post-war boom. We then got into the 70s and we had that stagflation, followed by the Reagan era. So, 10 years we had, Reagan era. And yeah, we had different things that happened. Black Monday, end of the Cold War, these different things. We got to the 90s and obviously we had the tech boom kind of leading into the 90s. And then we had the tech bust. We kind of came out of the tech bust, got back to even. That took about a decade. And then we hit the financial global crisis. We kind of came out of that, started chugging along, and here's that little blip of the coronavirus. So we'll see where this thing goes. One question is, do we get into another super cycle, another 15 type of year super cycle? We'll see. This thing's been going on for a long time. We had a recession. Everyone was calling for a recession. Hey, we've been going on for too long. With this recession, with the Federal Reserve's help, I'm starting to, especially with all the economic data that we're looking at, start to think we're at the beginning of probably another pretty good bull run. We'll see. I mean, it's fragile right now. A few things. What causes recession? Well, a spike in commodity prices, okay, an aggressive Fed, and extreme valuations. So what you're looking at here is the last 12 recessions. You see number 12 being the global financial crisis. We could come over here and we could pick, the 1987 crash, point number 10. Or we could come, here and we could look at, point number 7 being, a different tech crash that happened in the 70s. But my point being here is, look, if you go back and you examine these things, one of three things or a combination of three things led to recessions: spikes in commodities, an aggressive Fed, extreme valuations. Let me explain. Spike in commodities. Many of you on the call today remember the 70s where there was lines of Cadillacs waiting to fill up their tanks and they couldn't. They only sell them a few gallons, right? That was a spike in commodities. Some people reference a few crashes that we had during the 80s. We're in that go-go 80s period, and Volcker would raise interest rates overnight and really not give anybody kind of direction on it, and it would cause, crashes in the market, although short-lived. And extreme valuations. We all remember the late 90s and the dot-com bubble, right? And so on PE ratios, the highest that PE ratio has ever been, I believe, and don't quote me on this, but I'm right around the number 193, and I believe that was May of, I think it was like May of 2000, right before the bubble burst. So what do we have going on today in those three areas? Very quickly. Everyone right away said, yeah, don't we have a spike in commodities? Well, what you're looking at here is you're looking at the price of oil. June 3rd, 2008, a barrel of oil was $145. February 12th, 2009, $33. June 13th of 14, 106. Yeah, we were all the way down here, folks, back in April of 2020 when oil hit zero for a day. But an average barrel of oil in April of 2020 was $11.57. On March 31st, we're at $60 a barrel, or more precisely $59.16, and WTI closed at $59.65 yesterday on the board. So, is this really a spike in the price of energy? No. In fact, it's fairly inexpensive. That said, we do expect to see oil kind of trend higher. We expect oil to kind of end the year in 2020 in the mid to higher 60s. That will lead to inflationary pressures that could lead the Fed to maybe start to think about raising interest rates, which I'll talk a little bit more about on the next slide. So the Fed has said, hey, listen, we're not even going to think about raising interest rates until 2023. Now, this chart that you're looking at here is on the Fed's website. And so they give you predictions on where they see, their federal funds rate target going. And as you can see, by 2023, it's at 0.30. So basically no changes from today. Now, previously, right, their long-term projection is about 2.5. They were trying to get their rate up to about 3 back in 2019. Things are too fragile to do that today. They won't be raising. Derek, what if inflation starts to take over? Well, again, this is based upon today's data. If we get huge amounts of inflation like we had in 1970 or in the 70s, you may see the Fed need to raise rates sooner. Now, with that said, you always hear this term, good news is bad news, right? So if we see inflation maybe picking up, and one of the reasons why we would see inflation picking up is we get that unemployment rate way down, Companies are doing really well with profitability. Wage growth is going up, at least more than inflation, and things are going really good. Well, the Fed has over 100 PhDs that work there, and they've been students of what federal fund rate increases can do. So typically speaking, when the Fed does raise rates, the Fed is privy to all insider information long before it's made public. Stock market sells off, then reports come out. Company earnings were still good, employment is still level or going down. And all of a sudden, the stock market starts to catch back up because the Fed got it right. The economy could support the increase of the federal funds rate. We'll see this time, right, because things are fragile, and when you inject a lot of cash into an economy, inflation can be a result of it. It was not a result when we did that in 2008 because we grew out of it with our GDP. So again, if our GDP is keeping pace, this injection of liquidity won't be a big a deal as many people think it will be. But we shall see. Again, I talked about valuations earlier. So back to that chart when I was talking about PE ratios, April 1st, 2021, the PE ratio of the S&P 500 was at 20.1. And the forward PE ratio, 23.12 as of April 1st. And so things are a little frothy, right? But here's the one thing with valuations. There it is. So maximum PE ratio, I said 135. It was 123, and that was May of 2009, right before the technology bubble burst. So right now, this is a little bit of an area. It is an area of caution for us. However, in light of the fact of inflation being low, wage growth being high, injection of liquidity into the economy, unemployment rate going down, vaccines going out, will companies grow into this PE ratio, right? Because this PE ratio may actually, even though it's high, right? What I'm saying is perhaps it's low. Perhaps we'll see corporate profits be much better than expected, and therefore right now it's not as frothy. And so if you remember from our speedometers, equity market valuations, we had that circled. Again, if I go back to this chart that I showed you earlier, this is actually a chart that I added today, but kind of to put some sense inside of it, what you see here is you see this blue line, and this blue line is a 50-day moving average of the S&P 500. You then see that yellow line, and that yellow line is a 100-day moving average of the S&P 500. And so one thing that we always talk about is reversion to the mean. Things revert to the mean. Well, when I added this particular slide today, at that time, you can see that the green right here, that's where the S&P 500 was, 4,091.84, okay? This little pink line that you see, that is a 5% above the 50-day. This red line that you see that I'm kind of putting my mouse on there, that is 7%, and then this thick red line is 10%, okay? And so when we talk about reversion to the mean, the point being here is, look, the mean is someplace between the blue line and the yellow line, right? Those are just the averages. And if we were to kind of go someplace between the blue and the yellow line, it's about a 6% pullback from here. Now, with that said, especially with the good news of vaccinations and economies opening back up, so on and so forth, remember, this line is also being affected. Those lines are also being affected by what happened through February and March, right? So these lines could actually catch up to the S&P 500. And look, if it was normal, like if everything was normal right now, we didn't have this big surge of reopening, I'd be arguing the other way around. I'd be saying, hey, we probably will revert back to the mean. But I have a sneaky suspicion that companies will have great earnings, give good forecasts, and will actually grow into that valuation. So anyways, steps for you to take. If you're on the presentation today and you're a client, keep us in the loop with important life changes. Tell us about concerns that you have. We're not always bulls. Many of you know that. We're not always bulls. I see too many of these presentations and everybody's a bull. We're not always bulls. I'm simply giving you an educational presentation on where we see the markets today based upon economic indicators. Make sure that your important legal and financial documents are up to date. I can't tell you, especially through the coronavirus pandemic through 2020, and still to this day, how many calls I'm getting of clients that we've had who have experienced someone in their family passing away, so on and so forth. And I can tell you horror stories about it, and I can also tell you not fantastic stories about somebody's family member passing away, but from a legal aspect, from an estate planning aspect, I can tell you stories that went perfectly smooth, and I can also tell you stories that were just a mess. Steps for us to take. We'll keep you informed through regular communications. In fact, some of you probably have our stuff going to your junk box because we send out about 3 emails a week and we do these types of presentations. We'll manage your investments according to your personalized strategies that we've developed for you. Of course, we always stay on top of changes in the market environments and we make prudent adjustments where necessary inside of portfolios. Listen, because it's a webinar, we don't open up for questions because it can get noisy and people can't hear. And then when people sign off, it plays this whole recording. But when you get the slides, if you'd like to set up a time to talk on one of the slides, you can. You can click on set up a call, or you can set up a go-to-meeting, and we can share screen. Of course, if you'd like, you can come into the office. Also, as I mentioned previously, we do have our events page. You can see past events inside of there. We will have a lot of future events going up. There is nothing right now on the website for future events, but we'll have a lot coming up between now and July. And of course, just like all of you received this email, you'll also get emails about those future events that are coming up. Anyhow, thank you all for your time today. I probably went over, but only by 9 minutes it looks like. So I thank you all for spending an hour with us. I could talk about this stuff for the next 5 hours. In fact, I kind of felt rushed through it. So thank you all for joining us. We do appreciate it, and hopefully this kind of put in perspective 2020, where we are today, and kind of where we see things going through 2021. Again, even though the picture I painted was somewhat rosy, I think we will have volatility, especially with inflation fears and good news perhaps being bad news, etc. But come December 31st, I think very similar to 2020, we'll have a very good overall rate of return in the general markets, S&P 500, that type of thing. Anyhow, again, you have your handouts, and you can review this stuff. You'll all get a recording of this tomorrow. And please, visit the website if you do want to chat with me. If for some reason you weren't able to download the notes, just email, we'll schedule, or just go to the website. And if you go to my profile, you can schedule right there. Anyways, again, thank you all very much, and thank you for spending an hour with us. Have a wonderful, wonderful rest of your day. Thanks so much, and we will talk soon. Okay, bye-bye.